In most countries, taxes are structured in a progressive system, meaning that individuals with higher incomes are expected to pay a larger percentage of their earnings in taxes. However, the ultra-wealthy often find ways to significantly reduce their tax burdens. Through a combination of legal strategies, loopholes, and sophisticated financial planning, many of the world's richest individuals and corporations manage to avoid paying the full share of taxes that is often expected of them. This disparity between what the wealthy can pay and what they actually contribute to public funds is an ongoing issue that has sparked widespread debate. While the average taxpayer has limited options for reducing tax liability, the rich have access to resources like high-priced accountants, lawyers, and advisors who specialize in minimizing tax exposure. The result is a system where the wealthiest individuals legally navigate the complexities of tax codes to retain more of their income. In this video, we will explore the various methods the wealthy use to reduce their tax bills and the implications of these practices on the economy and tax fairness. Understanding how these strategies work is crucial for anyone interested in how wealth inequality is perpetuated and the broader impacts of tax avoidance on society. But before we dive in, I need you to leave a comment saying, "My financial dreams are coming true." Positive affirmations attract good things into our lives. So comment, "My financial dreams are coming true." When I see your comment, I'll give it a heart. Now let's continue. A tax loophole refers to an ambiguity or gap in the law that allows taxpayers to reduce their liability without technically breaking the rules. Loopholes often arise because tax codes are incredibly complex and are created through legislation that, while attempting to be comprehensive, leaves room for interpretation and exploitation. While average taxpayers might not have the resources or knowledge to identify these gaps, the wealthy can hire experts whose entire careers are dedicated to finding and exploiting these loopholes. One well-known loophole is the carried interest loophole, which is commonly used by hedge fund and private equity managers. In this case, income earned from managing other people's investments is treated as capital gains rather than ordinary income. Since capital gains are typically taxed at a lower rate than ordinary income, this allows managers to significantly reduce their tax burden. Instead of paying the top marginal income tax rate, they pay a much lower capital gains rate on this income. Loopholes like this persist because of political influence. The wealthy and corporations often lobby lawmakers to create or maintain tax rules that benefit them. The lobbying process can lead to the intentional creation of laws with vague language that leaves room for exploitation. As a result, what might seem like an unintended consequence of complex tax legislation is often a carefully crafted provision that favors specific wealthy interests. One of the most effective ways the rich reduce their tax burden is by reclassifying their income so that it's taxed at a lower rate. In many countries, there is a significant difference between the tax rate on ordinary income, such as salaries, and the tax rate on capital gains, profits from selling investments like stocks, bonds, or real estate. Ordinary income is typically taxed at a progressive rate, which increases as income rises. However, capital gains are often taxed at a lower, flat rate, regardless of the amount earned. Wealthy individuals often structure their compensation to take advantage of these lower capital gains rates. For example, instead of receiving a high salary, which would be subject to the highest income tax rates, many executives are compensated in stock options or equity. When they eventually sell these shares, they pay the lower capital gains tax rate rather than the higher income tax rate. A particularly common strategy is to hold on to investments for the long term. Many countries offer a lower tax rate on long-term capital gains, investments that are held for more than a year before being sold. By holding on to assets for extended periods, the wealthy can reduce their tax liability while benefiting from the appreciation of those assets. In addition, some individuals utilize strategies that allow them to defer capital gains indefinitely. This means they never have to pay taxes on the appreciation of their assets as long as they don't sell them. By borrowing against their assets rather than selling them, wealthy individuals can access cash without triggering a taxable event. Charitable giving is another avenue through which the rich can reduce their tax liabilities. While philanthropy may seem like an altruistic activity, for many wealthy individuals, it is also a savvy tax-saving strategy. Most tax systems allow individuals to deduct charitable contributions from their taxable income, reducing the amount of income subject to tax. Wealthy individuals can create private family foundations, which allow them to donate large sums of money while retaining control over how those funds are used. These foundations allow the donor to receive an immediate tax deduction, even though the funds may not be distributed to charitable causes for many years. In this way, the wealthy can lower their tax burden in the present while continuing to manage and invest the foundation's assets. Moreover, the wealthy often donate assets other than cash, such as stocks or real estate. When they donate appreciated assets, they can avoid paying capital gains tax on the increase in value of those assets. The donor gets a tax deduction for the full market value of the asset, and the charity can sell the asset without paying taxes, as most charities are tax-exempt entities. While charitable giving undoubtedly benefits society, the ability of the wealthy to use it as a tax-saving mechanism raises questions about the fairness of the system. For example, the establishment of large foundations allows the wealthy to have significant influence over social causes while reducing their tax burdens. This has sparked a debate about the balance between genuine philanthropy and tax avoidance through charitable donations. Real estate offers numerous tax benefits that the wealthy can exploit to reduce their tax bills. One of the most significant advantages is the ability to deduct depreciation on real estate assets. Depreciation is a non-cash expense that allows property owners to account for the wear and tear of their properties over time. While properties may actually appreciate in value, tax rules allow owners to deduct depreciation as though the property were losing value. This deduction reduces the amount of taxable income a property owner has, even though the property itself may be increasing in value. Another commonly used strategy is the 1031 exchange, a provision in U.S. tax law that allows real estate investors to defer paying capital gains taxes when they sell a property if they reinvest the proceeds into another like-kind property. As long as the profits are continuously reinvested in new properties, taxes on those gains can be deferred indefinitely. This allows wealthy individuals to build significant real estate empires while avoiding paying taxes on their gains. In addition to depreciation and tax deferral, the wealthy also benefit from mortgage interest deductions. When purchasing properties, they can deduct the interest paid on loans used to acquire or improve those properties. This deduction further reduces the amount of taxable income they report. Real estate plays a key role in estate planning, where wealthy individuals can pass down significant property wealth to their heirs while minimizing inheritance taxes. For example, by placing real estate into trusts or gifting fractional interests in property over time, the rich can reduce the estate's overall value and thereby lower the tax burden on their heirs. Trusts are a fundamental tool in the tax planning strategies of the ultra-wealthy, particularly when it comes to transferring wealth to the next generation. Trusts allow individuals to set aside assets and dictate how and when those assets will be distributed. Different types of trusts serve different purposes, but they all help reduce the tax burden on the transfer of wealth. One popular tool is the Grantor Retained Annuity Trust, GRAT. This type of trust allows individuals to transfer assets to heirs while retaining the right to receive an annuity for a fixed number of years. After the annuity period ends, any remaining assets pass to the heirs with minimal tax liability. If the assets appreciate significantly during the annuity period, the heirs can receive a substantial transfer of wealth with little to no estate or gift tax. Generation-skipping trusts are another mechanism used by the wealthy to pass wealth to grandchildren or even great-grandchildren, avoiding estate taxes that would normally be levied at each generational transfer. These trusts allow assets to grow tax-free while skipping the estate tax on the generation in between. Additionally, irrevocable trusts can be used to remove assets from an individual's estate, ensuring that those assets are not subject to estate tax upon their death. This allows the wealthy to effectively reduce the size of their taxable estate while retaining control over how the assets are distributed. Through these techniques, wealthy individuals can minimize or entirely avoid estate and gift taxes, ensuring that a larger portion of their wealth is passed on to future generations. Business ownership offers a wide array of opportunities for tax avoidance. The wealthy often structure their businesses in ways that allow them to reduce their tax liabilities. For example, many use pass-through entities like S corporations, limited liability companies, LLCs, or partnerships. In these structures, the business income passes through to the owner's personal tax return, and the owner only pays taxes on the income once, avoiding the double taxation that occurs with traditional corporations, where income is taxed at the corporate level and again when it is distributed as dividends. In addition to structuring their businesses to minimize taxes, business owners can take advantage of numerous deductions to reduce taxable income. For example, they can deduct expenses related to business operations, including travel, meals, office supplies, and even a portion of their home if they use it as a home office. The ability to deduct personal expenses that are reclassified as business expenses provides an additional avenue for tax reduction. Another powerful tool is deferred compensation. Many wealthy business owners and executives choose to defer their salaries or bonuses to future years, thereby postponing the tax liability on that income. This strategy is particularly effective if they expect to be in a lower tax bracket in the future or if they want to avoid paying taxes on large bonuses all at once. Moreover, wealthy business owners often benefit from stock options and equity compensation. Instead of receiving a large salary, they are granted stock options or shares in the company. When they eventually sell the stock, they pay the lower capital gains tax rate rather than the higher income tax rate, saving significant amounts of money. Another powerful strategy that the wealthy use to avoid paying taxes is the use of offshore tax havens. These are countries or jurisdictions with favorable tax laws, often low or no income tax, that attract individuals and corporations looking to shelter their assets. Popular tax havens include places like the Cayman Islands, Switzerland, Luxembourg, and the British Virgin Islands. While the average person might not have access to or need for offshore accounts, for the ultra-wealthy, they are a key tool in deferring or entirely avoiding tax payments. The use of shell companies is one of the most common mechanisms for offshore tax avoidance. These companies often have no real business operations but exist purely on paper. A wealthy individual might transfer their assets to a shell company in a tax haven, thereby shielding those assets from their home country's taxes. Additionally, offshore trusts can be used to legally hide wealth. By placing assets into a trust governed by the tax laws of a different country, individuals can avoid paying taxes on those assets or delay tax payments indefinitely. Offshore banking is not illegal when properly reported to tax authorities, but it can be easily abused. Many offshore tax haven jurisdictions have strict privacy laws, which make it difficult for authorities to track down hidden wealth. This makes offshore accounts a prime vehicle for tax avoidance. Notable cases have revealed how individuals and corporations alike use these tactics to shelter trillions of dollars from tax authorities. One of the most surprising strategies the ultra-wealthy use to avoid paying taxes is the practice of borrowing against their wealth. This tactic is often referred to as buy, borrow, die, and allows individuals to access large amounts of cash without selling any of their assets, thus avoiding triggering a taxable event. Instead of selling investments like stocks, which would generate taxable capital gains, wealthy individuals take out loans using their assets as collateral. Because interest rates on loans are often lower than the tax rates on capital gains, borrowing against assets can be a more cost-effective way to access funds. Additionally, the interest paid on the loan can sometimes be deducted, further reducing the individual's tax burden. This strategy is particularly effective for those with significant wealth tied up in appreciating assets like real estate or stocks. By borrowing against these assets, they can fund lavish lifestyles without ever having to sell anything or pay taxes on their gains. When they pass away, the assets can be passed on to their heirs, often with a step-up in basis that resets the value of the assets for tax purposes, allowing the heirs to avoid paying taxes on any of the appreciation during the original owner's lifetime. The strategies used by the wealthy to avoid paying taxes are diverse and highly effective. The rich have a wide range of tools at their disposal to minimize their tax liabilities. These tactics allow them to accumulate and preserve their wealth while contributing proportionally less to the public coffers compared to the average taxpayer. I hope you found this video helpful. Before you go, don't forget to check out my other videos. See you in the next one.